What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market, notably some monthly charts there. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 6 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description. If you're not into those links, that's a-okay. Just remember that a thumbs up button on the video goes a long way to show some support for the channel. Without further ado, let's jump right into these charts. So kicking things off on the SPY monthly time frame, talking about candle structure and location as we always do. The second bar in is the candle in question. We of course have more of a hammer-esque type candle with a significant lower wick and a strong green body stacked on top. The lower wick is significant because it represents the absolute failure from the sellers to get any price acceptance within the prior monthly range. And of course, the solid close up at the highs of the monthly range is incredibly bullish because we push even further outside of the prior monthly range to expand in the upward direction. In terms of a location perspective, we did produce on the bar-to-bar count a higher low as well as a higher high, which strikes me as bullish. But even more than that, if we think about this level right here, we're coming into a known area of prior support, which then offered resistance. And there's certainly the possibility for a couple scenarios to take place at this level. So let's talk about them briefly. Currently, the monthly trend count looks something like this, very similar to the weekly with lower highs in place. You could possibly consider this an equal high right here. Knowing that we're in a downtrend, for this to reverse, we would need a set of higher highs above here or a higher low pullback. If we get the higher low pullback and reattempt this level, which is roughly SPY 410, what would we produce? Certainly, I would argue that is looking like an inverted head and shoulders. We have a neckline there, and a breakout should take us much closer to roughly SPY 460. So longer time frame thoughts, of course, it will take multiple months for that pattern to unfold if it unfolds in the first place, but starting to speculate about how this trend could change on the monthly is reasonable because if we take out the Fibonacci's and come in from the very low of the sickness up to the high, notice that we tested the 50% retracement. We never went back down to it. And in the past month's worth of trade, we pushed, notice that we open here. We push underneath the 38.2, recapture it by the time we close out November. So we're back above the bullish Fibonacci, right? In the grand scheme of things, you could consider this area up here much more along the lines of bull flag consolidation. In between the two critical fibs, the 38.2 and the 61.8, we're more neutral and definitely more bearish underneath the 61.8, but we're just not there yet from a monthly perspective. So things are starting to shift, especially based on the structure here in that lower wick representing a big failure from the sellers. This is a much different tone than what we had closing weak on the lows here, weak on the lows here, weak on the lows here, right? Doesn't guarantee a breakout, but things to start considering from a reversal perspective. Let's take a look at the weekly time frame chart and see if any of what we just discussed aligns with what's taking place here. Of course, it's no secret that we're at the resistance trend line, but I would say that we've arrived in a different fashion this time around. Notice that here, it's really just a straight shot out of this balance area without any meaningful pullbacks on the weekly time frame chart along the way. Here is our breakout level, right? We break out, we put in a balance area, we break out again, we balance again, right? So the market has had much more of an opportunity for push and pull and the sellers to try to make a stand there as we come into the resistance trend line this time around. Again, this is not a guarantee that we break out over it, but the structure underneath us, you would have to agree, is much more healthy in relationship to a straight shot of a rally like what we saw over the summer. So that's a slight bullish data point that I'm looking at here. Of course, you could also make the argument that we have more of a bullish breakout of a micro bull flag here. You could make the argument that we've got a trend count that's starting to look like this with higher lows. Those are much cleaner on the daily time frame chart. But even if we do pull back off of that resistance trend line, right, let's just put that back up here. If we pull back, find a big weekly higher low, let's say that we get a couple of red weekly bars and then reverse to reattempt it again, you would have to say, right, after a significant higher low, that a reattempt of the trend line after the higher low is definitely increasing the odds of a break of that level. Notice that here, after the possible higher low, we never reattempt the trend line. So we don't, that would have been a bullish attempt here, and it will be a bullish attempt if we find a higher low first and reattempt in short proximity of time. So overall, there are starting to become some signs of possibility of trend reversal, but as we move through today's video, I think we'll uncover some slightly hidden data points that are actually starting to edge on the side of caution or even bearishness. So price action looks great on the higher time frame structures. Let's drill down to the, before we drill down, take a look at our volume profile, and we'll see what's going on from a high volume node perspective. perspective, right? This is that SPY 390 area that we had been really paying attention to on the daily time frame chart. We've spent multiple weekly bar closes above that now, which does strike me as a bullish data point. We've closed in the low volume void, and we know that roughly SPY 420 is much more of that next overhead resistance from a volume perspective. Keep in mind that that is ultimately that resistance level from the monthly chart. There is prior support, resistance, resistance. If we pull back for a higher low, here is the monthly inverted head and shoulders that we were just discussing, also adds up from a volume support and resistance perspective. Now, let's take a look at our daily time frame chart and see what's going on from this perspective. 50 SMA in blue, 200 SMA in green. Where are our levels? There they are. Beautiful. Now let's discuss the weekly expected move. So as priced in by the options market, the expected move high is here, expected move low is there. If we are contained within the expected move, we would produce a daily higher low, and we would also produce a daily higher high, which of course keeps us in a daily uptrend. So the weekly expected move is bullish based on where the levels are currently. In terms of what's unfolded in the past week's worth of trade, I would also argue that the price action does ring true as being bullish. Here was a balance range. We of course break it on Jerome Powell's speech, consolidation bar right up at that resistance trend line. Here's where things get interesting. On the Friday session, we gap down with the jobs report, respect the top of the balance area, and then rally to close the gap and accept inside of the Thursday's range. So if the sellers were going to make something happen, if this was going to be a big old rejection off the resistance trend line, and we were just going to fall to pieces here, why did they not materialize on that gap down from Friday? They could have easily had a look above and fail, targeted the bottom end of the range here, and then from there, lower high produces a daily head and shoulders, break of the neckline. Now the daily trend is in the downward direction. It just simply didn't happen. So I'm not seeing the evidence of stronger sellers. And even if we take a look at like the hourly time frame chart, actually let's go to something even slightly smaller, like a 15. Notice that here's the gap fill reversal early on in the day's session. So first thought is great. Inventory is corrected. Now let's look for some lower action. It just didn't happen, right? So the sellers are not showing their hand as being incredibly strong at this point in time. And again, I think all of these things are worth looking at as we're coming into this juncture here at the weekly resistance trend line that everybody seems to be talking about as, you know, the end all be all for the market. You know, based on price, I'm not seeing the argument for stronger sellers, but based on risk on, risk off positioning, yeah, things aren't looking fantastic, which we'll dive into momentarily. So from a buyer's perspective, you of course just want to see the move up and over the resistance trend line towards the upper edge of the weekly expected move. For sellers, we just described how a look above and fail could turn into a head and shoulders pattern. That, of course, would change the daily trend. Before we continue into our market internals, let's bust out the Fibonacci's. Oops, whoa. Let's take out the Fibonacci's and take a quick look at where we've landed from that perspective. So from lows up to highs, we're well above our 38.2. Notice that it is now above our CPI gap, which is this area right here. So that is bullish in my perspective. If we take out the fibs from the highs down to the lows here, last trendline touch, right? Notice that we have now closed multiple daily bars over the 61.8, which generally increases the odds that you do make the 100% retracement. It means, and I want to use this very, very lightly, let's think in terms of probabilities, right? We're always thinking in terms of probabilities. The more times you close above the 61.8, the safer this low becomes, and the odds of revisiting this generally decrease, right? So far, so good from a Fibonacci perspective. Really interesting, in some prior videos, there was a very great response to the anchored VWAP. So here it is, anchored VWAP from the trend line, well underneath us, support for confluence above the CPI gap close. Same thing from the 2022 lows. Here is the CPI VWAP, right? We're above that. So anyone who, or the average, quote unquote, average buyer who's participated from then is above water. They're feeling good. And even anyone who participated on the Wednesday rally, longed on Friday, is still, again, based on the average of the volume weighted average price, above, right? You can see price closed above that on Friday. So overall, some bullish data points here when we're just looking at price. That's what I've got for you here. Let's take a look at our market internals and see what's going on from this perspective. Let me load those up for us. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial on that. Here we go. The main takeaway is that we've got bullish inflows by the close of the week. I know everybody's waiting on this script to get posted to the site. I'm working on it. It's a one-man show over here. Bear with me. So I'll get that up there as soon as I can. But so far, inflows into the end of the week. Of course, much of that was produced on the Wednesday rally. But it just goes to show that it greatly overshadowed the selling pressure from the Monday session. So now that we've established that inflows were in place, let's take a look specifically at the Tuesday session, because Tuesday, in terms of price action, was bearish in our S&P 500. What did the Tuesday volume flows do? They were bullish. What did the Tuesday advanced decliner do? It was bullish. What did the Tuesday cumulative tick do? It was flat. So again, I'm not seeing any evidence here that stronger sellers are stepping up. This is more like liquidation break as opposed to big new money shorts entering the market from an internals perspective. Here is our market profile. All I would point out from this is, again, I would reinforce the idea that as the gap down took place on the Friday morning session with bad jobs, or well, bad, right, quote unquote, bad jobs numbers, they were actually good. The sellers did not run away with it through this thin structure. I mean, look at the volume that was through the Jerome Powell rally. I mean, there's just nothing there. So the sellers really shouldn't have had any issue opening right underneath this little blob of acceptance, pushing prices lower and moving through that structure. It just simply didn't happen. Again, no evidence of stronger sellers currently. Value area was overlapping on Friday instead of breakaway to the downside. Point of control closed inside of the Thursday value area. So again, prices are being accepted higher as opposed to lower at this point in time. And the last thing I would leave you with here is if we scrunch this chart way up, and let's not get too aggressive. Sometimes it's finicky. The last point of control breakout, right? So from here has been tagged up. We have no VPOCs down here, down here, down here. This was not left as the VPOC. The VPOC actually moved higher, which is not a VPOC anymore, but the point of control just moved higher on the Wednesday Jerome Powell breakout, right? You can see that little dash up here. So overall, the structure underneath us is sound. So not seeing stronger evidence of sellers, not seeing any deficiencies in terms of structure beneath us, but what is starting to become slightly concerning is that if we take a look through our sectors, we're starting to see some defensive posturing, right? So let's do that now. XLB, really lightweight sector, not going to read into it too much, just getting rid of those anchored VWAPs. Overall, this does strike me as, bullish, obviously breaking out of a bull flag here. So we can see some continuation, but really lightweight sector, not going to make or break the market, not overly concerned with that. XLC is one of these areas of concern, right? Here was the original balance. Now you can sort of redraw it as this. It's got to get in gear over 52 to aggressively start working well for your S&P 500. If this just noodles around and dribbles back lower, back into this range here, I'm not really all that impressed, remembering that the XLC is more of a risk-on sector as opposed to defensive. XLI has really fueled a majority of the rally. We know that from right here. It's coming into known areas of resistance, which we've discussed in the past. If we zoom in, you can certainly start to make the argument for this looking like a much more clean rising wedge, which is a bearish pattern, right? These incremental higher highs, bulls are getting trapped up at the top, right? Any sort of breakdown of that trend line, and maybe we head back down to the lows. If this is not performing for our S&P, the baton must be passed to the XLC, the XLY, the XLV, like all of the risk-on sectors, right? We need to see improvements there, and as we'll see, let's take a look at the XLY now. We're not quite getting them, right? The XLY, sure, it made a step in the right direction, don't get me wrong, recapturing this 143, but overall, not really impressed with any particular breakout over 148.85. We're still stuck in this balance range. So steps in the right direction, but needs to break out here to, quote unquote, catch the baton from the passer, which is looking like the XLI at this point in time. Next up, the XLV. This is coming into the top end of the monthly balance, so it would be reasonable to expect this to start to slow down up here. Being the second heaviest weighted sector for the S&P, if this slows down, again, what needs to pick up the slack? XLY, XLC. XLP, what's going on with consumer staples? Staples, remember, are a D for defensive asset class, more of a risk-off look, and the chart actually looks great, right? This looks like it could break the three equal highs there, pressure cooker top, at a known area of prior resistance and continue its ascent. Right, this is not a good look for your S&P 500. Noting in a minute that we'll see value is outperforming growth. XLK, what's going on in the tech sector? Certainly a better look. Don't get me wrong. This is much more bullish than what we just saw in the XLY, XLC. Trying to resolve the top of this balance area, what would be more ideal is getting above that 200 SMA. So steps in the right direction. The pattern does look bullish up here. It's not like we gave back too much of the Jerome Powell rally. But remember that and his very clearly forecasted 50 basis point rate hike in December and the slowdown of rate hikes, let's see if tech can start to take advantage of that. So far, hasn't really been the case, right? We need to see some follow through from this move and actually push outside of this range instead of just chopping around inside of it. This is, okay, but if the market's going to get in gear and the SPY is going to continue higher, we need to see this start outperforming in the upward direction. Take advantage of those low rates, darn it. Let's take a look at the real estate sector. So really lightweight, not going to read into it too much. With the possibility of rates coming in, or at least the slowing of the pace, I would imagine it's bullish pressure overall, neutral through here, lightweight sector, slight bullish pressure up here, only really concerned with breakdowns that are new lower lows to be watching for impact in your S&P. XLF for financials, very similar to the XLI. We know it's coming into an area of resistance. We had sort of this look above and fail on the Thursday-Friday session, really underperforming on Friday relative to the market, right? You can see this 0.59 versus 1.16. Overall, I think that financials are in a position to possibly slow down. And again, if this is not going to carry the S&P 500, we need to see that rotation, right? I'm not going to keep beating the dead horse. Utilities, what do we see here? Really thin structure off to our left, could easily see continuation to roughly 74, which is the breakdown area and the double top. Right? And remembering that utilities are really D for defensive. This is a risk-off look, not great for your S&P 500. So as we're coming into this inflection point, although the price action and we're not seeing evidence of sellers in the SPY itself, the positioning out there is starting to become the cause for concern. Right? And we're willing to flip bearish if we get that head and shoulders outcome that we just described on the SPY. Energy is a D for defensive asset class, and this, being risk off, actually looks good to head lower. This looks more like a distribution pattern as opposed to like a bull flag. Right? You could make the argument that sure, if it goes, it goes. But so far, the rounded nature of the top, the lower highs that have been putting in place, right? A breakdown of this trend line, I would start to look for this lower, closer to the 84, which is actually comfortable for your S&P 500. All right. With that, let's take a look at the relative strength by using our ratio grid. If you don't know what the ratio grid is, top right-hand corner's got you covered with a brief tutorial. Top 4 are the risk on sectors. Notice that the XLK looks okay. We talked about it in the daily balance area on the structural chart. It's got to improve. XLV, nearing the top of its monthly balance. I wouldn't be surprised to see a lower high from here to here in the ratio, which would, of course, not be great for a risk-on look. XLF is already breaking down from a double top underneath that neckline. And the XLY, our good old friend here, is lagging like we've never seen before, right? It's just totally in the dumps, not picking up whatsoever, which makes sense based on the structural chart. So we're not seeing continued looks for risk on in the market. XLI, it's still hanging out up here towards the top, but we know we're contending with resistance. Communications are starting to perk up, but it's not as heavyweight as the big 4 up in the top. The bottom 4 are the risk-off sectors. Notice that the XLP is looking good for an ascending triangle breakout. The daily chart looks good for a bull flag breakout. Not a good look for your S&P. Energy coming in certainly is a better look. Real estate going sideways is okay. And utilities, we noted that if everything else starts to fall down a bit, if financials fall down further, if tech can't get in gear, if healthcare slows down, right, you could easily make the case that utilities could start to outperform through that area of thin structure on the daily time frame chart. So overall, not loving what I'm seeing from a ratio perspective, starting to become a little bit more cautious of this market. Let's take a look now at that XLY XLP relationship. We were just mentioning this prior, right? So growth versus value. Value is certainly still in the driver's seat. Let's just call it that, for lack of a better term. The next look here, inflection point, would be, do we break the trend line or not? If we break, bullish for the S&P. If we just start to break down further, that is bearish for your S&P. Look for this to actually start to come lower if we start making aggressive lows underneath this 1.88 area, which the market's really been struggling with recently. Let's take a look at the dollar. This is a classic bear flag breakdown. There's your bear flag breaking down. This is a bull case for equities here. You want to see continued price acceptance underneath 105 in your dollar if you're an equity bull. Taking a look now at what's up after the dollar, our TNX. Where are you? We want to look at the signal study specifically, which just monitors where the rate of change crosses through the zero line. We're still getting bullish signals, and the most important part here is that the rate of change is continuing to get deeper into the negative territory. Remember that this is good for your XLK, but the XLK has to get in gear in the upward direction and start to take advantage of these lower rates, right? If it doesn't, then it's kind of all for nothing. And to me, it's much more of a sign that, hey, Jerome Powell is going to have to swoop in here and essentially bail out the economy. Speaking of, let's get a little bit fundamental here. We'll try to keep it brief. Last week, we noticed a strong shift in tone, which we have not seen in quite some time, right? So sure, we gapped down on the NFP number here because the traditional relationship, or at least as it's been the past 6 months, is that bad news is actually good news, and good news is actually bad news. But Notice that what we described on the SPY daily time frame chart is that we filled the gap and accepted in the Thursday's price range. So now good news was actually good news. And what this is starting to show us is that we need to see some improvement in the economic conditions. Otherwise, again, it's much more of a signal that Jerome Powell is going to have to come out and bail us out with an aggressive rate cut. And when that happens in bear markets, we've presented the data in the past, right? Traditionally, a rate cut is bearish for your equities, right? So let's go ahead and take a look forward at what we have on the docket this upcoming week. Core PPI is coming out on Friday. Definitely be aware of that. That's a precursor to inflation numbers, which come out on Monday of the following week, month over month, year over year. And then, of course, on Wednesday, the big Fed press conference, right? So we'll see what happens. Jerome Powell was fairly transparent that 50 basis points is likely on the table, and the Fed tracker tool is agreeing with that as well. Taking a look over here, 75% likelihood that we do get a 50 basis point rate hike. After that, in February, a 25. Pretty neck and neck here, though, whether or not it's another 50 or a 75. We'll see. A 50 or a 25. Apologies, 25 being here. Current favor is 25. Definitely a 25 here. 25 in May. And that brings us up to our terminal rate, which is expected around 500 to 525, right? Let's continue along to the June, and then we're expecting a rate cut there as soon as possibly June. Remember that a rate cut is not typically good for equities if we are in a bear market. This is, again, more of a sign that Jerome Powell will have to come to the rescue and bail us out. So we want to see continued indications that good news is good news. That's our fundamental take for the day. Let's get back on over to the platform and take a look at our TLT, which is aligning with the idea that risk off could be around the corner. This is one of these things that, sure, on the weekly time frame chart, and when we're zoomed out like this, it's historically low, the relationship to its ratio to SPY. But if we take a look at the daily time frame chart, notice that TLT, the 20-year, has actually been outperforming equities over the past little bit here. So if equities see a pullback from the trend line and TLT continues in the upward direction, remember that this is much more of that classic quote-unquote flight to safety, which would not bode well for your S&P 500, something that we're going to continue to monitor. And again, to avoid this becoming the case, good news should continue to be good news in its relationship to data drops with economic data and how the market receives them. Okay, so we're starting to see that shift. We want to continue to see if that is the case as we move forward. Let's take a look at our HYG, just because I want to point out that we no longer, this is the skew, apologies. Let's go to the HYG. Too many charts these days, huh? So HYG, right, we were monitoring a divergence between here and here. That has currently resolved. But what I do want to point out is the LQD, which is your investment grade corporate bonds, right, made a significant higher high on the Friday session. This typically would bode well for bonds, think TLT, right, outperforming in the short term, which again is not great for your SPY. So something to consider. If they move in tandem, then that's a different story. But if they don't move in tandem, again, it's more of an indication of classic flight to safety. TLT and bonds will likely outperform, meaning that your S&P might take a hit as it becomes less attractive. The main thing that investors are probably fearsome of as of right now is that sort of earnings and valuation recession that's being discussed, right? If earnings and continued forward guidance comes in as misses, which is currently happening right now, then looking forward, not great of an outlook for the economy itself. Here's the SPX A200R percentage of companies in the S&P over the 200 SMA. Remember to avoid the 08 look. We wanted to see more price acceptance over that 0.5. Certainly have multiple weeks closing above. This does stack up as a more bullish data point at this point in time. Let's take a look at some volatility products and see what's going on from the VIX perspective. I wouldn't blame you if you're cautious in your S&P 500. Here is another bearish data point. Notice that as the VIX has come into historically this 2050, at least in the past 6 months or so, almost a year at this point, it has marked the tops, right? It doesn't mean that we have to do something like this. The relationship can be broken at any given point in time, but I wouldn't blame you being cautious at that resistance trend line. Again, let's just sketch that in here quickly. Every time we come to that resistance trend line and the VIX is at this 2050, it seems like there's some bad news that comes out. Could it be the CPI? I don't know any better than you do, but I'm at least being cautious here with new money longs in your S&P. So hopefully, as we've walked through the data points today, you can see that the S&P price action and structure itself looks great. We're not seeing the evidence of stronger sellers, but in terms of positioning and under the hood type dynamics, we are starting to see some signs of risk off coming back into play. Let's take a look at the VVIX before we wrap up our S&P look. All I would point out here is that we're not seeing a divergence between the VVIX and the VIX itself. This is not aggressively ticking higher as the VIX itself is coming in, you know, sort of continues to indicate complacency with this bottom that was put in during the month of October. Last but not least, for volatility, let's take a look at the VX futures for any signs of inversion. And no, we are in a strong contango. All good. There is more risk in the future than there is in the present day. Money managers are content outlying capital under these present conditions, but we'll see if that TLT starts to outperform aggressively and the sectors continue to be positioned in a defensive manner. Let's get on over to the QQQ. We'll round up the broad market here with a couple of monthly charts, quick top-down analysis on these charts here. So the QQQ, I don't know what this level is doing here. Let's remove that. Overall, same idea as the SPY, right? Bullish hammer candle here, closing at the highs, no acceptance in the prior month's range. To me, it's a little bit weaker, obviously, because it's underneath that SPY equivalent of the neckline of the possible, again, not guaranteed, but possible inverted head and shoulders, continuing to monitor for some upside into that 320 here in the QQQ from the monthly perspective, noting that this structure does indeed look bullish. Let's take a look at the weekly time frame chart. See what's going on here. Overall, trying to resolve this as a bull flag. All of it's happening above what you could consider a weekly double bottom. Does strike me as being more bullish than bearish. Again, your target, probably on the weekly chart, you would look for 310 first on your upswing, not quite that 320 we just saw on the monthly time frame chart. Daily is up next, and we'll pop on our levels, of course. Expected move is bullish. Again, much of the same psychology will apply here to the QQQ that we just described in the SPY itself. Overall, you want to see continued price acceptance over 288.75. Higher lows here, build out a bull flag, continuation in the upward direction, fantastic. If we get the similar look above and fail situation like the SPY, lower highs underneath 288.75, possibly change the trend, underneath 281.25, and we would also be falling back down into the original balance area from in here. That is where your trend would change. That is where we will clearly start to shift our tone. Let's take a look at the IWM Russell 2000, and the small caps monthly time frame chart is up first. Clean, there we are. Monthly chart, much more of a double bottom instead of the inverted head and shoulders. So to me, it's all about this neckline here, which is also in accordance with the prior support, which then turned into resistance. Watching for breakout, the level to watch on the follow through would be closer to 210. So monthly structure looks good. Looks good, to be quite honest. Again, no acceptance in the prior monthly range with that lower wick. Let's go to the weekly time frame chart. What do we see here? Compressing in between the two critical moving averages, much more of a bull pennant type look. Again, a breakout gets you closer to that 200, right around in here, which is shy of the 210 monthly level we just described. So resistance coming in early there. Notice that the IWM has outperformed by, again, not putting in a lower low from this perspective. Again, not the inverted head and shoulders. It's the double bottom on the monthly. And if we go to the daily and pop on our levels, as we typically do, just, again, same psychology, higher low, higher high, keeping us in a possible continuation formation on the daily time frame chart. That was a rhyme, poet, you didn't know it. So daily balance, though, on the IWM, absolutely. Equal highs are in play, equal lows are in play. So this is much more neutral as opposed to your S&P, which looks bullish, as opposed to your QQQ, which looks even slightly more bullish than the IWM, just by a hair, right? This is more neutral. QQQ is more neutral. SPY, definitely a little bit more bullish and being the outperformer of the bunch currently. But watch for, just from structure perspective, right? Watch for a break of these two equal highs. If that does happen, you're just looking for this expected move high, right? And from there, higher low pullback gets interesting in the upward direction. Trend will change underneath and filling this CPI gap from right on over here. That's been an in-depth look at your broad market. We had to spend the time on it because, as I've pointed out, there are starting to become some divergences between what we're seeing from a sector perspective, a positioning perspective, and a pure price action perspective at a critical junction point, which we know as that weekly resistance trend line. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll dive directly into Apple. This chart is currently, not really great looking. Reason being is that, sure, we had a nice bullish close of the week, but we're just running into this overhead area of supply. You could think of it as a possible break retest. Are we going to head back lower? That is to be determined. As of right now, we do have on Friday's close a move over 146.75. So not bearish until we get back down underneath, I would say at this point, the 50 SMA and Friday's low. If that does happen, the door is open for lower highs and equal lows to be back on the table. I would look for this gap to come back into play. For the buyers, I would just wait and honestly be patient. Let this price range resolve, and bulls are more content over 153.15. Next up, we've got Netflix. Definitely a clear outperformer over the past week, continuing to push into this overhead gap. Beautiful price action as we made the move higher here, just complete, beautiful higher lows, higher highs along the way as well. I would be watching for a continuation move to close the gap and then watching for a possible pullback. The daily trend is clearly up with higher lows as well as a higher high now in place. So even if we do pull back, a beautiful higher low could be placed at 303 for trend continuation in the upward direction, even as low as 292.50. Don't get me wrong, if we do go to 292.50, it does open the door for the possibility of head and shoulders, right? Something that does this, but it is acceptable being above the sort of double bottom neckline, which, gave the breakout its legs in the first place. So that's my Netflix opinion. Tesla, definitely looking like a possible inverted head and shoulders on a deeper pullback here. You would want to monitor that neckline around 195. If we do break it without the pullback first, I would just be skeptical as we're getting a break and retest on like a higher time frame of this level around 205.25. So Tesla's definitely not out of the woods. It's in a weekly and daily downtrend as well, starting to show some signs of improvement here for bulls. Any consolidation that puts in a flag that looks like this over 187 is probably the most optimal outcome to look for that scalp to move through that range in the first place. Definitely reassess when and if we make it to 205. Breaking above 205, I'd have to update you in possibly the Wednesday video. You've got this big range to contend with over here. We could easily just chop around inside of it. Bears want to see a move underneath the low of this range to negate the possible inverted head and shoulders, right? You want to see a move underneath 177.12, and we'll reassess when and if we move underneath that gap from here. Google is up next. Chart definitely looks more bullish than bearish. Remember that communication sector is trying to get in gear, breaking out of the balance range here. Friday supported at the top, and currently it is looking like it's trying to stay above for a bull flag consolidation phase here. Now, obviously, the resistance point is around 103. If we clear that, there's some clear sailing up until 106.25, about a $3 range on a $100 stock. Definitely something worth paying attention to. Bears are more content with a look above and fail underneath 98.55. Next up is Meta. Metaverse has also been an outperformer this week, which is ironic because I thought that the chart looked quite hideous, to be frank with you, in this area. But hey, just goes to show you win some, you lose some. I have not been participating in this upside, and instead, I would say it looks like it can continue with the bullish engulfer, but I don't necessarily know that I want to be getting involved after 3 aggressive up days, at the higher highs. I would prefer to wait for some sort of pullback, and maybe we can buy the pullback to 118.50. Maybe we can watch for some consolidation and then a break to close the gap. But just buying this blindly up at these highs does not strike me as the most risk-friendly entry. So chart does look good. I would not be aggressive on the short side here. I would watch for, as we just pointed out, this situation or pull back to possibly here or here, as we've just described. Remember, just like Netflix, it can technically afford to go to where the breakout stemmed from, close to 114.50. Next up, NVIDIA. Chart looks great, to be honest with you. All chips really do. AMD, as you can see over here, as well as TSM, are on our trade idea watch list, looking very similar. But overall, you got the bull flag forming, you got the hammer candles back-to-back up at the highs, breaks, and confirmation closes over now. 168.50, watching for that continuation into our prior set of highs and 200 SMA. 178.50. After that, of course, big double top in play at 192.25. Chart does look better than many things that we've seen so far, just from a structure perspective. You've also got this type of thing going on, ascending triangle, right? So as long as we're in the triangle, that stays in play. I would only be concerned about bear outcomes underneath 154. Next up is Microsoft. What's going on with Softy? Break the 3 equal highs, game on for the gap overhead, right? That's going to be right around in here. 200 SMA is baked in at the top as well. Looks good, right? This honestly looks like, I forget what sector it was. XLP was it? Consumer staples. Looks good for upside if we can crack that level as a scalp. Remember that you want to see this maintain and hold above at this point, either 250.75 or 247.50, which were both breakout levels. Your highs from here or your highs from here. Anything that stays above is bullish. You can see we did hold up on Thursday and Friday with that lower wick proving support, and the seller's not able to run away with it to the downside. So bullish edge in Microsoft, only concerned with bear outcomes underneath at this point, the lower edge of the consolidation at 240. Last but not least, we've got the mini beast, Amazon. What's going on here? This is possibly the most lackluster name on the board, down 0.37 in a sea of green from Friday. Just can't get in gear. Right? Can't get in gear. I would not want to really touch this at this point in time now that it's really failed on both ends of the range, here, and here. I would just be patient for a break one way or another. So you're watching 97 and you're watching the gap down around 90 underneath us for the next directional move in Amazon. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's dive right into these trade ideas. Kicking us off is none other than the infamous AMZN. Dizzle. You'll catch the inside joke if you tune into the live streams in the morning. Regardless, we've got a clean bull flag look here. Daily balance area looking for the break of 77.75. Wow. Into 85 roughly from right around in here. Very similar to that NVIDIA trade that we were just looking at from that perspective. Again, chips are looking quite good at this point in time. The trade is in play as long as we stay above 72.38. Next up, we've got Disney and the Bob Iger takeover. What's going on here ever since the takeover, which was this gap up day there? We've been consolidating high and tight with the possibility of a breakout point over $100.75 for a move into roughly 110. Let's just do some simple math. $10 move on a $100 stock equates to a nice clean 10% move. That's if, of course, big caveat, if we make it to the target from the entry in the first place. Regardless, that is a substantial move. Definitely something worth paying attention to, especially note that we've got thin structure through the breakdown in here. You can see prior support, resistance, right? That's where the target's coming from. It's in play as long as we're above 96.18. Next up is TSM. This is an ADR, so just be aware of the possibility for gaps in the overnight session to be quite choppy. But regardless, it's very similar to AMD and NVIDIA with your bull flag look breaking out over 82.85, brings us into 91.65. So again, about a 10-point move just for round numbers sake, but this is even better than 10%, right? So worth keeping an eye on here. It's in play as long as we're above 78.75. Next up, CrowdStrike. Earnings absolutely wrecked the stock. Big gap down here, but since then, strong buy response from the market, right? You can see clearly outperforming volume than what's typically in store for CrowdStrike. So everybody wants a piece, and what we're looking at overhead is a possible 3-bar play, inside bar breakout to take us through the double gap, right? We've got a double gap from not only earnings, but this move back around in here. So over 125, first target's 130.65, then the gap closes much closer to 136. So watching for some upside here. Not really interested if we can't get in gear on a momentum-looking breakout over that 125 zone. Next up, we've got Snowflake. What's going on with Snowflake? What you'll notice in this one is we've got an inside bar, so a 3-bar play, if you want to look at it like this, to the resistance trend line, right? So just on a day trade, that could offer a little bit of upswing there as we come into contact with that 50 SMA. So basically looking for over 153.75, 154 to get to the trend line, which is closer to 158. So about a 4-point, let's just round down there, right? A 4-point move available in snow early on if that happens in the first place. And then a bearish trade idea. We've been talking long. What about the bears? Certainly looking for a breakdown underneath this. Technically, it's not an outside bar. We made an equal high, higher low, but underneath the inverted hammer low, right? Certainly you could start to make the argument for a failure from the buyers up at the top. You've got trapped buyers. Think about this like a poor high, like a market profile reference, right? First inclination is that you move lower. So underneath this low could easily target the low of the double top neckline, which is closer to 160. It's about a 7-point move available on the downside here in First Solar. That's all I've got for you in today's episode. If you did appreciate it, again, thumbs up button goes a long way to show some support for the channel. If you learned something new, let me know down below in the comment section, or the thumbs up button works just as well. With that being said, I'll catch you in the morning live stream at 8:30, and I wish you all a green trading week.